Today's guest builds a place-based private equity engine in West Michigan, trained operator, buy the business and hold for the long haul. So far, Sleeping Giant Capital has partnered with 7 searchers to acquire local companies and plugged in a talent pipeline through Western Michigan University. Fund 1 was 34 million, and now they're raising Fund 2. Thanks a lot for coming to the Holdco Builders podcast, Doug.
Thanks so much. Happy to be here.
Before getting into your wild journey of buying businesses, what were you doing before? Please, let's start with your background.
So I've had a very non-traditional path to where I am today. It's been an oscillation between business and academia, and I think I've gone back and forth many times, and ultimately I ended up with a foot in both worlds. So a foot in higher education, teaching in a business school, and a foot in running Sleeping Giant and an investment fund, and so that's been a really unique journey. I mean, I've spent some time in advertising. I spent some time in management consulting. I got my PhD, became a tenured professor, and then started Sleeping Giant with my partner Derek McIver. So I would say I've got a pretty unique background. I don't know anybody else who has the kind of strange makeup of influences that I've had. I mean, I was a psychology major as an undergrad, never took a business class, and now we're buying businesses. And so I've always tried to really bring the best practice, the evidence, what is the current understanding of what's the best way to do something with the actual practice of doing it. And those are just two different worlds. You've got nobody needs to know the theory of the golf swing or the physics of a golf swing to be great at golf. You need someone to help you with the practice. But then you look at somebody like Bryson DeChambeau, and he hits it a mile. I mean, there's somebody who has gotten into the physics and the theory of the golf swing, and so these things are mutually beneficial. I think that higher education, for many good reasons, gets a bad rap. It can be a little bit out of touch. It can be not as focused on the practice of doing business, especially. I also think that there's a lot of value in resources, and I think that can be unlocked if you can do it in the right way. So that's really been my background is between these two different worlds, and I fit in really in no world. My higher education colleagues see me probably as a self-interested capitalist, PE barbarian at the gate. And all of my business owner and board members and friends tease me about PhD is piled higher and deeper, and you're irrelevant and out of touch. So I fit nowhere all the time.
Okay, but still, you've accomplished a lot already. Where did it all started? Why did you decide to do what you do today? And what was being this PhD, your analysis capabilities and research capabilities, why you decided to do what you do today?
It's a great question, because I could tell you the story about how this all was planned out, or this kind of deep reason. I would really say I just really go after what I find interesting and fun. And when I feel like I've really gotten a handle on something, I'm always looking to the next thing to kind of learn. And so I'm very curious. I'm always wanting to be a little bit outside my comfort zone and trying new things. And working with great people. I think I've really, in most of my pursuits, when I find really great people, talented people that are just high quality people of integrity, people of great character, I just love building things with those kinds of people. And so when I have opportunities to do that and it seems fun, then I go after it. So I think fun sometimes, and people talk about money, they talk about status, they talk about meaning and purpose at work. I just sometimes think fun is underrated, and so just having fun at what you do has been a big source of kind of where I've navigated my career.
What has been the timeline for Sleeping Giant Capital so far?
Yeah, so Sleeping Giant, we started with this idea back in about 2019. My partner Derek and I started on a whiteboard with a couple ideas of what we could put together that might be really interesting in West Michigan. And started doing a little bit of research on the silver tsunami and, all these things around baby boomers exiting, and, search was starting to become a little bit of a thing at that time in 2019 at HBS and Booth. And so we just started that conversation in 2019. The pandemic hit in 2020, and that was at the beginning of our fundraising period. And so we hit a little bit of a interesting period there because it was, the world had stopped and fundraising had stopped. So there was a little bit of start and stops there through the 2020 to 2022 to get our feet under ourselves. And then really in 2022, 2023 is when we really had the core of our model developed. We had raised the search vehicle that we have. We had raised committed capital. We started to, make some investments. So that was about 2-3 years ago when that really started to finally come together. So that's been the timeline.
Now, before talking about the fundraising, I'm sure you have many interesting stories from there. But what about the story with you and Tarek? Where did you guys meet? And if we take the core team, what about the strengths and weaknesses? A quick break. Doug, Tarek, and their team at Sleeping Giant have backed many independent sponsors and have already bought 7 companies. If you would like to invest in a similar type of businesses without running them day to day, you should go and check out CapitalPad. CapitalPad gives accredited investors access to curated SMB acquisitions, the kind led by searchers and independent sponsors, buying established, profitable companies in sectors like home services, healthcare services, light manufacturing, IT, and many more. You see a full deal room, take financials, tax returns, sponsor profiles, the value creation plan, and you can co-invest in a per deal basis with a minimum starting at $25,000. There's no management fee. Capital only participates if investors get their capital back and profits are earned. Or if you're an operator under LOI, CapitalPad can help fill the equity gap and bring trusted network of co-investors so you can close with confidence. Again, these are long-term, illiquid investments and involve risk. You can learn more and apply at capitalpad.com. That's capitalpad.com. Now back to the show.
So Derek and I met as professors. We both got tenure in our department in the business school and kind of looked at ourselves and said, okay, well, what's next? I think we both had a real passion for being entrepreneurial, making an impact, doing something that was going to be lasting and enduring beyond us. We also had, I think, a real interest in, creating something that would benefit. We always use this phrase, impact as many people as possible, as deeply as possible. And so we thought, well, what could we do that could drive returns for investors, could create these new career paths for entrepreneurs and buying businesses that would be a great option in the marketplace for sellers who didn't want a traditional PE buyer. That would be great for the university. And, we kind of would be great for West Michigan. You kind of go down the line. And that was something we were really excited about was, creating the big win. One of our mentors, Dick Hayworth, has this phrase, create the big win. You can create a lot of value for yourself with a small win, and you can do that quickly. It sometimes a little bit harder, takes more time, creativity, create the big win, but that can be a little more rewarding and meaningful in the long term. So it was really, I think, just shared values and interests that we kind of started on this idea of putting these pieces together. And then, we're self-taught. I mean, we have taught ourselves how to do this. We have learned by doing. We are not coming from a big mega PE fund and spun out. We haven't been at an investment bank for 10 years. And so, there's a lot of learning by doing. There's a lot of seeking advice. I would also say this: it's difficult, but it's also not. People, I think, sometimes overcomplicate. What needs to be done. It's solvable, but that's probably been our weakness. Is we were a first-time fund with first-time fund managers, and that's always a difficult spot to be in, and you're learning a lot. Always need to protect the downside in those cases. But I'd say those are our weaknesses. Our strengths are, I think we're both very analytical. We both have the ability to work with an understanding of finance, strategy, relationship building, people skills, communication skills. I think the relationship communication skills are massively underrated, I think, in M&A, especially now that you have AI. I mean, AI is really going to take a lot of those analytical skills off people's plates. It's really going to be about people. Everybody's going to have the same tools. Everybody's going to have, an agent in Excel, and they're going to build their LBO in 5 seconds and drop financials in, even messy financials. It's going to make sense of them. So building out the relationship skills, I think something is, we're really good at. So those would be, I think, probably where we're strong and, where we still can develop and continue to develop every day.
You said something like putting the pieces together. And you've also said that calling Sleeping Giant Capital, if Brent Beshore, Warren Buffett, the search community and the university had a baby. So can you talk more about what did you maybe learn about each parent, if we can say that?
Warren Buffett, Brent Beshore, the ETA search fund community, and a university had a baby. That is us. So, I mean, we just are an amalgamation of a lot of influences there. So, if you look at, we'll start with a Warren Buffett, holdco, recycling capital, no distribution. I'm going to allocate cash that comes back from businesses and reinvest them into other growing businesses. If I can keep them, those earnings still in those companies and reinvest, fantastic. If I can, I'm going to use it to make other acquisitions. Taking the long view, a real hesitation around looking at EBITDA and looking at short-termism, protecting downside. I mean, so many lessons there. I think having a Midwest sensibility and a thoughtfulness, a humility, I think we really draw from. Brent Beshore, I think, he's obviously a Buffett protege as well. This notion of that you can raise a long-term vehicle and, you can go out and buy businesses and have a 25-year term fund, and that's you can create an engine that actually works in that way. I think that's really been an inspiration for us. Obviously, the search fund community and ETA, that whole model, I mean, I'd say it's well institutionalized now. When people talk about 3 tranches, or they talk about, I mean, it's taken for granted. Everybody just kind of assumes the search model. I think that has a lot of benefits to it. It also has, I think, some aspects to it that people take for granted and don't question. But that notion of finding entrepreneurs, being entrepreneurial led, not being the fund dictating and really controlling, but it's really the entrepreneur's search, partnering with great entrepreneurs. That's been a big influence for us. Some of the economics as well. And then university, we have created Sleeping Giant with the idea in mind that our portfolio companies are going to have access to, resources and capabilities and students at the university. These are not McKinsey consultants, but there's a lot of unseen value there. And I think that's our contrarian bet. I mean, everyone would say, well, why would you be doing this with university students? I think there's a lot of unseen value in universities in a multitude of ways. And, Sleeping Giant, our portfolio companies have access to growth strategy projects with the undergraduate program we teach. So it's been a combination of a lot of those elements that has informed, the model we have today, at Sleeping Giant, and then in connection with the university.
Now, when it comes to fundraising, you had your model, your mandate, you knew what you wanted to do, and you also have said that when you were pitching Fund 1, you got the easiest no ever. So what type of investors were you approaching in the beginning, and what was the feedback, and how was the overall journey, and what changes did you made over time so you were able to eventually close the Fund 1?
We went in with the notion that raising institutional capital would be difficult, given the unique elements of our model, both the long-termness, the place-basedness, the fact that, a first-time fund with a first-time fund manager is the easiest no in the world. No consultant loses their job by, recommending KKR or Blackstone or whatever. They would lose their job by saying, hey, look at these first-time fund guys, look what their kind of unique model would be. So that's an incredibly easy no for, any institutional investor. Despite the fact, by the way, that the evidence is that first-time funds really outperform other funds. That's not going to get them over the line. So we went in with the idea that institutionals would be tough, and that, if you wanted to raise significant enough capital, it'd be high net worth individuals and family offices, folks that can take the long view. We're a place-based model, so you start with a notion that people in our region are going to be interested in what we're doing and see the value beyond the return, in addition to the return. And so that was really our starting investor pool. We had some conversations with institutionals, even knowing that we were likely to get a no. It was great feedback, especially early on in the process. I mean, one of my recommendations is always on fundraising is always go to the people you expect to know first and get their objections and their pushback right away, because that's going to help you tailor for the folks that you actually want to and partner with. So that was really our process, was kind of start with institutional, get the no's, get the tough feedback. What's their mental model? I mean, we're not a typical model. They want the kind of the easy. They have these mental models in their brain that just gets them down a path, and so we needed to know what those things would be. So that was really the process, and then it was just a lot of relationship building, a lot of emails. This is a relationship building thing. Even if we knew that they might be not investing in the first fund, they might be an investor in the second fund. So, that's, all those no's still add up to create value for you fundraising. So
what type of companies were you looking for? What would have been your ideal investment?
We started off looking at businesses that were a little bit on the smaller side, more in that, kind of million in EBITDA size to kind of maybe 2 million in EBITDA. And that size it's an interesting size. They're not platform for sure. They have a very involved owner operator. Typically, there's not a management team where the owner can be passive. Much more volatile earnings. Just not as high quality of a business. You also have competition at that size from the individual sponsor, from the searcher, from somebody who can put together friends and family capital, an SBA loan. And so what we realized was, and also our message about being a place-based long-term buyer, that value prop is not as compelling to that size, because they're not like a direct PE add-on. I mean, sometimes they are, but they're less of where you're going to get the strong PE competition. Where if you're at that 3-4 size, where you're kind of flirting with a more of a platform lower middle market size business, that's where the differentiation to PE really kicks in. That, hey, you can get your traditional coastal PE to buy you and then sell you off in 3 years, and amalgamate you into some larger thing where your brand and everything else kind of disappears. Or we'll be here for the long term and grow your company. That value prop resonates at that larger size. And obviously, higher quality businesses, it's easier to do one big deal than a bunch of small deals, and so we moved into that kind of 3 to 5 million in earnings size is a good size for us.
And what is the story with the first acquisition? Like, how did you find the company? How was the whole process? And maybe a few words about post-acquisition and how has it been so far? A quick pause and a lesson already from Doug. And one of the reasons he comes to and does episodes like this, Doug loves to build relationships at scale. One way to do it is to go to various podcasts. The other way is building a newsletter. And that is why I partnered with Spacebar Studios. They build and scale B2B newsletters, so you stay top of mind with people who really matter. And what Spacebar Studios does is they're offering 3 Holdco Builders listeners a 2-week free trial of Spacebar Studios. They will set up your newsletter. They will send your first few editions, and they prove the channel works. They do it with no fees, and you literally have no risk and no cost. And who knows, when by actually doing this, you and your business can start building a relationship at scale super fast. So go and start your free trial today by going to spacebarstudios.co. Again, spacebarstudios.co. They literally do it for you for free. If you want to get the link, just go to the show notes. Now, back to the show.
Yeah, so we made an investment in Line Drive. Was our first investment, and that was really getting our toes wet into what this was going to look like. I think SignComp was our first soup to nuts, sourcing the operator, having the search vehicle together and really the full model from Sleeping Giant. Sign Comp was the seller was somebody that I was connected to on LinkedIn. Had the same university connection. We had someone else reached out to them about are you interested in selling, and we made an introduction more about if he would be interested in selling his company. So there was both a university personal connection and then a broker connection. Kind of from there, we had conversations and built a relationship. And Justin Murray did a really good job of doing that with the owner. And Jason's a fantastic guy who was the owner there at SignComp. And I think he felt a good fit and trust with us, and we felt a good trust and fit with him. I mean, he's a Western grad, and so there was the Western University. Again, the value of the university connection was there. And then we made that acquisition, and so far it's been really good. I mean, we're looking at ways to continue to grow organically and pursuing some other opportunities that might help facilitate growth. So that's been a very stable. It's in a very stable market. The sign industry is a very kind of non-cyclical, resilient market. If there's companies, if the economy is growing, people need to put new signs out on their business. Because there's new stores. If stores are closing and going bankrupt, they need new signs too. So it's a very stable business, and so we like the product that they have. It's a superior product to some of the manual options that are available in the marketplace. So we see a big market that can kind of continue to grow for the long term. That was really our journey there with the first deal.
And what was the size of the business? Was it in this range you said, like 1 million EBITDA?
No, this was much larger.
Much larger.
Yeah. This was much larger than the ones that we were looking at. And I would say kind of within, 6 months of searching and really having some conversations with these businesses at that size, you realize that you just have a much superior business at, the 3 to 5 kind of million size earnings.
What do you do with those owners post-acquisition? Do you buy 100%? And maybe you can share a little bit about the structure. Do they stay around for a year or how has it been?
We've done many different things, to be honest. In that transaction, sometimes, let's step back. So we have had transactions where sellers have completely exited. We've had transactions where sellers retain a little bit of equity and participate on the board. We've had transactions where sellers are keeping a little bit more equity in the business. We're buying a majority, but they see some real upside potential and want to partner with us for a longer period of time. And we've had situations where sellers and owners have wanted to, take most of their chips off the table, but still kind of be inside the business and be a little bit more operationally focused. So it's really a case-by-case basis of what we think is going to be best for the business, best for the CEO, what the seller wants. And so we're not rigid in how that has to be.
What were the biggest lessons for yourself personally, like now you're owning a business, now you have to take care of the business, you have to grow the business. What were the biggest lessons for yourself?
Buying a business is much easier than operating it. And I'm not an operator. So, finding a deal to do a transaction is one thing. Taking that company and doubling it over a period of time, and that process, I think, is much more challenging. And that's why we really partner with amazing, really experienced, aspiring owner-operators. These are not 25-year-olds coming out of MBAs. These are experienced post-MBA, high-quality individuals. It's easy to make investments to get money out the door. I wouldn't say it's super difficult. I think growing them over the long term can be much more challenging. I would say the other lesson that we have learned is, always kind of planning for the worst and making sure when we go through a diligence process that we are just absolutely making sure we have stared the downside in the face. And if you can stare the downside in the face and really understand what would be true if that happened, how likely is that to happen, and understand that, you're really freed up. And so that's been a big lesson for us, especially looking at cash over a period of time where things are acute and making sure that we've really planned for that. That's been a really important part of the process for us because it it allows you then, it allows a certain level of freedom after you know, like, okay, we could get through this. This is what this would look like, and making sure that you've really buttoned that up. I'd say the other thing we've learned is, it's simple, but doing one larger deal is much simpler than buying multiple smaller deals and trying to put them together. We've done both. You're doing the same amount of diligence, all the legal agreements and quality earnings and everything else. You're doing that 3 times versus 1 time. And so, and it also then speaks to the kind of shop that you need. If you're a Shore Capital where you're just doing, a gazillion add-ons, you have a machine that's built to do a gazillion add-ons. And we're right now not a shop that is built to do a gazillion add-ons. We haven't to date. I don't think we will have a real roll-up approach. That's been a really interesting lesson. I think the final thing, as you go through this is just, when people talk about how emotional the process is, everybody's like, oh yeah, you're selling your legacy and this and that. You don't understand it till you lived it. Just how attached and almost irrational, and the psychological dynamics that come out through these transactions for people on both sides of the table is super, super strong. And so you really need to have a clear head and a detachment from that. It's easy to get swept away by those things, but having a real sense of people and being a great listener, being a great communicator is just so critical, because once the emotions kick in, it can really go haywire. You're not dealing with a rational process.
If you'd looked at your CRM so far, 7 investments, but how many deals have you looked at? Like, how picky you are?
It's a great question. I would love to know this exactly myself, what that number is. I almost think that's a myth, though. What everybody likes to say is, they want to talk about a very big denominator. Plus, like, I can look at a really big denominator too. I mean, all the opportunities that are out through brokers, through banks, you can see a ton of stuff and make your denominator really big, so your numerator looks really small, and so you look really picky and exclusive. I don't know how meaningful understanding the denominator is. I think it's more interesting to look at the number of deals that you can kind of get to an LOI kind of valuation kind of conversation, a kind of an IOI phase. If you can kind of get to that phase, you've built enough trust and relationship with the seller that they're interested. They have belief in the owner operator. They have that's talking to them. They have belief in Sleeping Giant. They have there is some seller readiness. I mean, all of the deals we've done are not on the market typically, so seller readiness can be a real thing that you're not really sure about because they're getting an email or they've been referred to us and we're having a conversation, but they're not officially on the market. I think that's a better indicator, is how many of those do you really get to? That's a number we look at. And we want to see if the owner operators we're partnering with, if they're not to like a 3 LOI submitted in a year zone, we're kind of looking at, okay, what tweaks do we need to make to change that? But that would be a number where if we're going to have an LOI out to them, that's sign that this thing is very close. And at that point, if you're off on price or you're off on readiness, which is usually the two things that might stop something from moving forward for us. It's never our model. It's never the people. It's often readiness. Sometimes it's price, but it's often readiness. That's the metric we look at, rather than the number of deals that we see in a year.
So in your previous interviews, you've said your operators first. Find the operator, find the deal. Can you maybe share your thought process when it comes to this? What have you learned, and why it maybe works better for you?
I think it's an interesting question, because there are deals that we see where we don't have the operator, and we have not found the deal and then went out and kind of headhunted an operator to run that. And there is something about the entrepreneurial leap of backing the person. You back the person. If I found the deal and then I find the operator, I'm not giving them the same economics that you would with search. I mean, search, the skin in the game is for you to go out and find the business, all the things that it takes to close that thing, and you get more of the upside. If it was a typical PE arrangement, I don't know, the management team's getting 10%, the CEO gets 5%. And it's a top-down process. It's our playbook. It's our thesis. It's why we like this deal. It's everything else. And so it is a top-down approach. I mean, I'm not a talented manufacturing operator. I'm not equipped to sit across from somebody and really know if it's a great opportunity or not. I need an expert who's somebody who has that background to work with me to help me understand, is this a good opportunity? And to have the fine-tuned understanding of that space. So by finding the person, you are really betting your model on people and betting your model on that entrepreneurial spirit where they see it as their search. They leave their job to do this. And for us, we like that. We like that mentality. We like that mindset. We like that level of ownership. That makes this whole thing work. And it's not relying on Derek and I as being the sole decision makers in a top-down process.
And where did you come up with this idea of putting together this 8-week course, and who created it?
So this is really my partner Derek is really the brainchild and leader of the Choir course. We saw back in 2019 some of the case studies out of HBS on ETA. Really saw that was one of the more popular courses at HBS at the time. And so we then just went through a process of looking at all the syllabi and different approaches of how folks have done that course, and really tried to design it for the pool that we're really trying to meet, which is the experienced professional, not the MBA student. When we went through that process, we realized that a class-based offering really isn't a fit with our target market. What we're targeting are folks who are currently employed. They want confidentiality. They want personalization. They want this. They're not taking it for an elective. They're not taking it for a certification. They're taking it because they want to buy a business. And so this one-on-one coached model really just came from better understanding who our target was and fitting what would best serve them. And so Derek's done an amazing job of putting together that 8-week course. It's a month of preparation. There's a lot of reading to do, and then every week they come in with an output that they would use. Like for instance, it's their buyer profile. They're putting something like that together. They're putting together an email that they would send to an owner operator. If we have a deal that actually might be a fit for them, that is maybe not in our wheelhouse, they'll have access to a live opportunity. So it's really creating actionable things from that process. It's not theoretical. It should set them up that if they wanted to go buy a business, and we've had maybe 10 to 12 folks buy a business on their own, not through Sleeping Giant, that they at least have the main building blocks to have a successful search.
So when it comes to those people who do this acquire course, if you can shortly say, what do you learn about them and what do they learn about you when we take this 8-week period?
So we learn what they would be really best fit to buy. So we understand what their background is and where they're really going to be successful. I mean, manufacturing is way too broad. We have to understand, is it high mix, low volume? What kind of substrate? Is it metal? Is it wood? Is it aluminum? What are those things that really make them the person, the guy or gal that a seller is going to be like, this is the person I want to sell to? So we get to understand that about them. We get to understand where their strengths and weaknesses are. I mean, they're building an LBO. They're putting together strategy and communications, all these different elements. You have to be so skilled at many different things in a search process, or being a CEO. We get to see through those different outputs, kind of where their strengths and weaknesses are. I'd say the other thing we start to learn is just what is their communication style? What's their relationship building style? Are they a little bit too loose and too fun that they need to add a little bit of seriousness? Are they too serious? Are they too aggressive? Are they too passive? And so we kind of learn the style that they relate, and we then can supplement that with either coaching or being there as a resource to help them be successful. I mean, and they get to learn about us. They get to learn about our model. They get to learn about the economics. They get to learn about how these deals are structured and what they can get from a transaction. What our investment thesis is. The constraints of our geography. That we have a geographical focus, so it's not an unlimited TAM. I mean, it never is, but it is in our case in terms of being, kind of place-based. And so they get to meet our team. So when they go through that course, they have the opportunity to meet with our financial analyst. They'll have an opportunity to meet with the individual that we just hired for marketing. So they just get to get a sense of what Sleeping Giant is, both as a fund, but also the people behind it. And so I think that process really creates that mutual understanding you need and trust if somebody wanted to take the next step and then apply to join Sleeping Giant.
How many people are actually going through this course, and what happens with them afterwards, and how many people are in that so-called like waiting to do an acquisition space?
So I'd say there's, maybe, call it 20 to 30 maybe folks go through that acquire course every year, of which we hope that 2 to 3 want to join us at Sleeping Giant. Out of that, 20 to 30, I'd say, another 3, 4 maybe per year are off on their own individual searches, looking for a company maybe in a different geography or a different size, or, it has a thesis on something that we wouldn't invest in. And so you've got some of those folks, and then you have folks that have taken the course and just say, not the right time. There's a number of those, not the right life stage, got young kids, got stuff going on that it's not the right time to search. And then you have a cadre of folks that say, really amazing learning experience. I'm going to stay where I'm at. I don't want to take that leap.
When it comes to searches, deal, and economics, are you able to share some of the maybe terms which create the right behavior when it comes to making those investments?
This is one of the inspirations from the the search community that so far there's a lot of reasons it's still good. We're still tweaking around with some different approaches to this to really adapt to our model, but for the time being, we like what it does. So there's just the same kind of 3 tranche equity vesting that owner operators get. So they get 10% equity for finding and closing the business successfully. So that's the incentive to take the leap. That's the incentive that it's your search. You're out there running it. You lead the diligence process. I mean, we're heavily involved with the diligence process, but you are that coordinating entity to make that happen. So 10% at close, 10% time based at year 4, and then starting at year 4, performance based with another 10%. We're looking at some other models that focus more on cash, but you've got different models that are emphasizing IRR versus MOIC, and shifting from IRR to MOIC at different time periods. And I don't think we have answered that question in a way that we absolutely love. There's always ways to improve it, but that's and so that 10-10-10 model, to my understanding, is still the best in search. I know that other accelerators are going to something in the 8s, 8.5, 8.25, or something like that for the 3 tranches. So we still believe that we're offering the best in class for that. And so that model is still what we use for the economics. And then they get a salary, and then we have bonus potential for each CEO. But that's our current economics for searchers.
So far, 7 investments. How has it been? If you can be honest, because I know you're raising fund too. We talk about this as well. What has been maybe some of the biggest challenges, or what are some of the
biggest challenges? You always are running into where a market is going, and a market is more whatever the phrase is. The Buffett phrase of a CEO and a market meet, and it's the reputation of the market that stays intact. The market is, and so we're dealing with some of that with the tariffs. Tariffs with automotive has created a little bit of turbulence, let's say. So that's been a real thing right now, though. So far companies are performing on plan. I wouldn't say that it's created any real crises or significant challenges, but it's limiting growth potential. So I think the power of the market and being smart about that, and diversifying, which we have done in those cases where we're exposed to automotive. We've made other investments to make sure that those are offset. I'd say another thing is, organic growth is really putting in place the systems and tracking you need to be successful to grow organically. A lot of these companies at this size don't have the ability to understand whether their sales and marketing efforts at going after organic growth are actually working. And so we have been more mindful to understand the systems that are currently in place and what we need to build in an investment, so that way we can actually track the effectiveness of some of the organic growth opportunities that we're exploring. I'd say the other thing that we've learned a lot is what is an effective board around these investments. I feel like boards, like strategy, like doing deals, making investments, there's all these different styles. None of them are really wrong. You can win with lots of different styles of how these things work, but putting together the right board in terms of its approach, the environment for the CEO to get really great expert advice and feedback, that's been a really interesting learning process to make those successful and make those fit what our style is and what our approach is. So those have been some big learnings on how to continue to grow these. But so far, companies have been performing to plan. And so we're excited about the future.
Fund 1 was 34 million. You're raising a larger fund too. What did LPs push you to keep, and what did they ask you to change?
So right now, they've asked us to continue to focus on the core of our model, which is being place-based, being long-term, creating the mutual benefit with the university here that we partner with at Western, continuing to support and work with really talented owner operators and keeping that. I think if anything, they've asked us to make sure that we are double down on making sure we're doing investments in our region, not getting distracted from other geographies that we could pursue, other places we could start a sleeping giant, making investments outside of our region, and really keeping our eye on building and executing what we've done. And I'd say it's really about, for us now, is creating something that's going to be enduring. And so building the systems, the processes, the people, the team that creates the enduringness of Sleeping Giant, and kind of moving from that first phase where you're just muscling deals over the line and you don't have a lot of, you have some process, but you're going through it new almost each time, to creating that predictability where the thing kind of runs on its own. So I think it's more been a double down and then a time to execute, guys, and make sure that you've designed a machine that can continue on into the future.
You mentioned long term many times, but how long? What means long term for you? What means for investors?
So Fund 1 had a 25-year term. So Fund 2 will be a little bit different. And we'll share more details about that in the future. But it is a bet on decades, not years, not quarters. And so we need to make sure that our investments fit into that time horizon. So things that are not going away. I love Portland Products for that. Portland Products is a metal stamper. They make mechanical assemblies for hinges for automotive customers, but also for customers outside of automotive. And if you think about a car and it's got a mechanical assembly in the seat, that's never going to become plastic. It doesn't matter if the car is electric. Doesn't matter if it flies. Doesn't matter if it goes underground. None of those things matter. If anything, these seats are going to get more complicated as autonomy allows for moving seats. So metal pieces in cars never going away. So we like to make investments that have that kind of time horizon. So 25 years is what we have shared with investors for our first fund.
25 years is a long time. What about the liquidity for investors? Because I'm sure many of them will say no right away if they hear something like this.
Many of them will say no right away. So there's cash distributions that come back to investors over time. So it's not like they don't see any money back. I mean, they will be getting cash back as soon as possible as we manage debt. So money is coming back. It's not like they're illiquid for that 25 years. There might be exits. There might be exits to other place-based buyers. There might be exits to the CEO. There might be exits to ESOPs. There might be exits to another CEO coming into the company. So there'll be opportunities. There's recaps. There's other ways to get to liquidity than a sale. And our investors are, I don't know, in some ways, I think it's a byproduct of the institutional nature of PE, which is that pension funds and universities, which rely on getting cash back to people, they need to get the cash back because cash is coming in the form of a pension. That drives that dynamic with PE. I don't know about you, but I have plenty of investments in the stock market that I have never touched, I never will touch, and probably won't touch for the next 20 years. Would I need it in the case of emergency to have a liquidity in the market and I could sell it? Yes. Am I really planning for that scenario? No. And so every quarter, every month, I get the statement, I look, and I set it down and I let it keep going. And so I think in some ways, a lot of our investors are just like that. They have made an investment. They imagine that thing is going to compound and grow over time. They might get some dividends back. I was doing a little bit of research on the average hold period of Berkshire Hathaway, and it's like 20 years. Nobody buys Berkshire because they're going to get a dividend. They don't do dividends. They buy knowing that they're going to probably hold it for a long period of time. And so we fit into a portfolio of investments that folks know that it's going to grow in value, but they don't need to see the money back today. They don't need to see the money back in 3 years.
Knowing this, how scalable is this model? Backing those talented owner operators, like how many can you manage?
That's a good question. So we can support 2 to 3 at a time who are in the CEO in residence program with us, where they're actually searching for a business. That kind of fits our size, that fits the market, that fits our current team, current capabilities. So I can't imagine us moving really beyond that for the time being. We like that pacing, and that the amount of capital we'd be deploying it fits with what our fundraising objectives are. So in terms of scale in our region, it's probably pretty fixed. Now it's just executing year after year after year of this model. I think the more exciting opportunity that I think would be fun is seeing what Sleeping Giant could do in terms of being replicated in another geography, whether Sleeping Giant monetizes that or not. I mean, I've been on a couple podcasts now. I would just love to see somebody who's inspired by what we've done to do it in their geography. I'm never going to compete, nor do I want to run something that's in another place. But I would love to see somebody like me take this risk and start something in their neck of the woods and create wealth for themselves and for their family and help a lot of people and do all the good stuff that we're doing. So I get excited to see Sleeping Giant or this model get replicated in other places, because the same things that are happening here, they're the same things that are happening all over the United States. If you have, closely held businesses that need succession, that are skeptical of being bought by coastal PE, there's a lot of places with those. There are places that have high net worth individuals, family offices that care about their place. Got a lot of great places with those. You have a pipeline of, or a pool of aspiring owner operators, often tied to Fortune 500 companies who are kind of feeling like they want to be entrepreneurs, but they don't want to start. You got a lot of places with those. And if you throw in a university, particularly one that's a regional university, maybe not a flagship, state school, but a place that's looking to do education differently, a street smart education, not a book smart education. Those 4 ingredients are in lots of places. And so to me, it would be fun to see whether Sleeping Giant participates or is branded or not, if it's open sourced, is to see the model kind of reach its full potential and have other communities benefit from that.
Maybe there is someone listening and wanting to reach out to you. Maybe their question is that, will I get Doug's WhatsApp? Will Doug coach me if they were building this in?
I would just think it would be fun. So I would love to engage with other people who are interested in this. And I think other people who are interested in a place-based investment approach, you don't see a lot of those where they're focused on place first. It has its drawbacks. It has its limitations. It's anytime that people are saying, well, that's a terrible idea. That doesn't make any sense. That's almost the time to kind of probe it a little bit further, because that's the contrarian view that you need to deliver alpha and some kind of return beyond the consensus. And so I'd love to connect with other people who are they don't need to be tied to a university, but that are interested in this kind of place-based approach, a bottom-up approach, a approach that keeps American communities owned and operated from their place and not from another place. It's just a dynamic that's such a macro trend. Search, I think, has really done an amazing job of spotlighting the opportunity of the silver tsunami and that whole shift and everything else. I think what they've missed is the implication of that shift means for when ownership of a community is based in other places. If you look at Trump's tariffs, if you look at America First, if you look at immigration, if you look at onshoring, what you're seeing is that place still matters. We went through this period where we thought place didn't matter, and people are now recognizing that place does matter. And so I think that trend of being concerned for your community and making investment choices that you can create wealth from yourself. We're not a concessionary. We have investors that are expecting a market rate return. We got to deliver, at least a 2x, a 3x MOIC and above a 20% IRR for us to be competitive with their alternatives. So that has got to be true, but that they know that they're doing good stuff in their community at the same time. So I'd love to see Sleeping Giant and what it's doing kind of, grow in other places.
Okay, I really enjoyed this conversation. I would like to do part 2 once you're live with Fund 2. So, and maybe a few acquisitions in. So thanks a lot for your time. 2 quick-fire questions. What is the best investment advice you've ever received, and what is your favorite book?
Best investment advice: don't lose money. Protect the downside. Don't lose money. Don't put yourself where you're out over your skis in any way, where you're going to lose capital. So never lose money is probably my favorite. This is not an investment advice, but I'd say the book that, again, matters the most for me was Chris Voss's book, Never Split the Difference. It's a book on negotiation, and the negotiation, communication, listening skill is just so huge. I just love that book and all the lessons that he has. And so I'm a huge Chris Voss fan.
Okay, so that's it for today. Thanks a lot for doing this, and talk to you soon.
Thanks so much.